This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. Do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds to give us 5 stars on Spotify or Apple. This helps with the search engine so that more folks can also discover and engage with all things MicroCap stocks. We're excited to announce that we'll be partnering up with MicroCap Club for our full slate of investor conferences in 2025. Ian Castle and his team at MicroCap Club have not only built and fostered the best community of microcap investors, but it's arguably one of the best investing communities, period. We couldn't be more thrilled to leverage our expertise in curating and hosting large-scale microcap conferences and teaming up with MicroCap Club to put together world-class conferences for the microcap community. First up, the Planet MicroCap Showcase Vegas in partnership with MicroCap Club will be held on April 22 through 24, 2025 at the Paris Hotel and Casino in Las Vegas. Registration is now live, so please visit planetmicrocapshowcase.com. See you in Vegas. My guest on the show today is Deiya Pernas, co-founder and analyst at Pernas Research. Growth, runway for growth, greenfield opportunities, current market penetration, competitive landscape. These are all concepts we need to think about when looking at microcaps, and we've talked at length on this show about. The idea or the ability to conceptualize the future for any given company is a skill I think we all wish we had mastered. Then we'd all be extremely wealthy. And yet, it's really what makes investing in small microcaps so damn fun. Deiya and his team at Pernas Research focus heavily on companies where their future is brighter than their current state. In other words, how the conceptualization of their futures are different from the market perception. We dig into this idea today and provide a few examples to illustrate what Deiya means. Deiya mentions a number of names during the interview today, and for full disclosure, I am not a shareholder in any of them. Thank you for tuning into the Planet MicroCap podcast, and please enjoy my conversation with Deiya Pernas. Thank you for joining me today. How are you doing?
How's it going, Bobby? Happy to be here.
Absolutely. It's great to have you. And, look, we're recording this on Friday, November 15th, so happy end of earnings season for this Q3. Is it time we bust out the I don't know, what do most people drink? Eggnog, right, around this time, or apple cider, I guess. I wish I had some to cheers you with, but it's good to have you on here.
Yeah, we actually do live close, so I'm sure we'll do that at some point. But yeah, I agree. I think everybody's excited. Holiday season and winding downs of earnings. We got through the election okay, so yeah, things are clearing up. Although volatility is picking up a little bit, which we always like.
Absolutely. So we're going to get into a whole host of things. We previously chatted, a few times now over the years. I mean, we caught up last week, but I mean, you had to refresh my memory that you actually came to one of our conferences back in like 2018, 2019. I'm not sure if it was under the Pernas Research branding. It might have been under something else, but as I joked with you on that, I was like, I've lived like 3 lifetimes since then. I appreciate reconnecting and wanting to find out more of your story, as well as your philosophy, strategy, as well as, co-founding Pernas Research with your brother, Dean. So, let's kind of start there in terms of your passion for investing, where it began, your background, and what led to the co-founding and founding of Pernas Research.
Yeah, so I've been investing for a long time now, ever since I can remember. And it really, for me, it started from poker, just kind of probability, uncertainty. There's the behavioral side of it as well. So all that kind of dovetailed pretty nicely in capital markets. I started investing with my brother, out of high school, and then the appetite grew from there. Got in the industry. You really start to understand how markets work, what do hedge funds do, what are all these different players that are moving, that are moving volume doing, and how they're thinking. And throughout that journey, you develop your kind of own insight, your own way of looking at things. We naturally gravitated towards stocks and company research. And then there's always the schools of thought that it's good to understand and then juxtapose kind of your spin on things, like value investing, growth investing, momentum, all the different factors, all the even the mechanistic ways you can trade in and out of stuff. I think all those are useful to understand. And then, yeah, while I was in the industry, one of the things that my brother and I noticed was that anybody who really produces research that is in the business of producing stock-specific research, meaning they're assigning ratings on names, almost, you won't find anybody that has a track record. It's very rare where you find a research shop that keeps a long-running track record of all their, different ratings. And we thought that we wanted to build a research firm that was really based on that principle. It's like, hey, we put out buy ratings on names. We invest alongside those initiation reports, and then we hire a third-party auditor that comes in and verifies our performance. So that way we have an objective track record that is comprehensive, reflects, everything we got right, everything we got wrong. So that way people can kind of see for themselves if we're any good at what we do. And it makes a lot of common sense, but it just doesn't seem to be prevalent. I'm hard pressed to think of an organization that does it quite like that.
No, absolutely. I mean, so really it almost became like a marketing play in a sense where, because most funds, because I guess the core structure is that you have your fund that you're actively marketing to outside investors to want to invest alongside with you, but you're making your research public in order for them to see, like, no, look, this is our process. This is how we do things. You can have full access to everything that we do, so that you can see, and it's almost more transparency in some respects.
So sort of. We don't actually manage outside capital right now.
Oh, you don't? Okay. I apologize.
It's all our own capital being invested alongside our own ideas. That being, look, if you can manage outside capital, I think, and you have the right investor base and so on, it's an unbelievable opportunity. That being said, when we thought about potentially launching a fund according to our strategy and, trying to market our track record, it takes an inordinate amount of time on the asset gathering side, on, setting up the vendors, getting the right seed partners, putting together the right growth strategy. And our core competency really lies in research and trying to develop insights and sitting at our desk and, doing a lot of analyst work. We probably wouldn't be that great at the asset gathering side anyway. So we decided to devote all our attention to what we're good at.
Interesting. So just, it definitely, we were joking, you're like, Bob, we have a very different strategy. And I mean, we haven't even dug into the investing strategy and what's different about that. But even just from a marketing business perspective with what you're doing, it's completely different. I mean, right now we were talking offline how, in MicroCap, small cap, there's a lot more sponsored research shops coming up. There's also a lot of folks tend to put out their research either to also just make a name for themselves, maybe built out a newsletter base, something like that, but I don't really, it doesn't seem like that's necessarily what you guys are trying to do. So what's the goal with making some of your research, with making your research public and available, but still not to draw in outside capital, but still just, you're only investing your own capital? I'm curious. Help me bridge the gap.
Yeah, sure. So the goal is really, there's an enormous amount of value in finance from, building an audience and readership base that trusts what you do and realizes that you're good at what you do. So we founded our Pernas Research in the beginning of 2023 with really the goal of trying to create a new type of, or a different type of equity research firm where the incentives are more aligned with the people who are consuming your research, whether they be on the institutional side or the professional investor side. We tend to want to appeal to more professionals or anybody who can understand the risks and rewards associated with the investing that they're doing. So the idea was, let's create something different. Let's put out research out there that is aligned incentive-wise. It's not coverage, it's actually strongly opinionated research, and it's not incentivized to oversupply buy ratings. We're only going to put out stuff that we believe in because we're going to own it ourselves, which is, clearly different than how the structure of a lot of research firms are set up. So that was really the goal, and build out our audience, build out our readership base, and to think about ways to monetize or to parlay that into a revenue model later.
You just answered my next question. Yeah. So
Yeah.
that's what I figured, is that is more of like a freemium situation where it's like put it out for free, build the reputation, get the reputation amongst the institutions. And then, ultimately maybe down the road, that might be a potential, I guess, customer. Right.
Yeah, I think so. I think it's incredibly hard in our business. There's so much noise in our business.
It's a
Everybody's
ton,
vying for
dude.
attention, which creates a lot of people doing things that for publicity's sake, or that's maybe not the most ethical. So if you're trying to do things the right way, I think you kind of have to have a lot of patience and just hang in there for a long time and just keep being consistent. And if you're good at what you do, eventually people are going to notice.
And at the end of the day, I mean, this is all the type of work you'd be doing regardless. I mean, because
Exactly. Yeah.
I mean, right? So you're
Yeah.
kind of like, all right,
Yeah.
might as well build up a track record. And hey, even if you never monetize, it's like, all right, well, whatever. We were gonna do this anyway. We're investing
Yeah.
our own money. Hopefully, we're making good picks, and let's go from there.
Perfectly said. Yeah, the most important thing for us is to enjoy what you're doing. I know it's a cliche, but it's one that it's easy to lose sight of because people are thinking about career building and different avenues to take. But at the end of the day, if you don't protect that enjoyment, if you don't put that at the top of the priority list, it's going to be very hard for you to be good at what you're doing for a long period of time. So enjoyment is definitely at the top of the list for us. It's what we think will sustain us and continue to make us better and better at what we do, because we're in the game, we're having fun, which helps.
Bro, this is altruism at its finest. Let's go.
Yeah.
All right.
Exactly. Yeah.
All right. So let's dig in a little bit on strategy, philosophy. You mentioned to me, last week when we were talking about the interview and how the style is a little different. So, let's lay it out there. What about your investing style, philosophy, strategy would you say is unique and different compared to others that are operating in the same field, operating the same, just looking at the same kind of stocks? Love to hear from the horse's mouth.
Yeah, I think our investment philosophy is quite different, and we're going through and really, codifying it all into a long form piece that we think will resonate. But one of the things that makes it so, and you got to try to use different language and stuff too, so people automatically don't bucket you in other different strategies. So we're trying to be very, very precise and deliberate about the messaging. But very simply, what we're trying to do is look for companies where their future is brighter than their current state, and your conceptualization of that company's future is different from the prevailing market view. And now, I know that may not sound different, but maybe this part will sound a little different. We're completely quality agnostic. We don't care about quality at all. So, and we actually don't even like the term quality because it has so many different interpretations by investors. Like if you put 10 different professional investors in a room and ask them to define, a quality company, they'll all have a different explanation. One will say, "Oh, I'm looking for companies with high levels of ROIC." The other will say, "Well, I need to see high levels of incremental ROIC." The other will say, "I need to see earning stability. I need to see a good management team." Like, there's no real convergence, which to me, that makes the term quality unhelpful anyways, just as a side comment. But why we are quality agnostic is that we don't really care what the firm looks like currently. It can be a bad company or one that optically looks terrible, but as long as it's going, as we have conviction that it's going to be okay, that is a potential investment. It can be a company that's okay, but if it's we think we have conviction that it's going to be good, that could be a potential investment. Good going to great, or great going to greater. So it's all about its future state relative to its current state, which allows us to look at a much wider variety of companies in the present day than most of our counterparts. Like, we'll look at companies that look terrible, or we'll look at companies that look amazing. We've owned, Facebook or Meta in the past. So to us, we think it's just a lot more clearly defined when you look at it in the future versus today, which also means that we lean into the prediction part of it. I know a lot of investors don't like to say that they're in the prediction business, or maybe it's a bit taboo, but everything we do is about prediction, and everything is about the future. And, we don't have a crystal ball. We don't hire a shaman. We don't, we're not astrologists, but we have certain
we are in
methods.
California. I mean, come on.
Yeah. I need to
Sorry.
adapt my view a little bit.
Yeah.
But yeah, it's all about prediction in the future. And there's certain ways that you can gain a concrete understanding of what the company's future will look like. And we can get into that. But yeah, so that's hopefully that gives you a little flavor of how things are a bit different.
Absolutely. No, that's definitely unique. I mean, I've never heard that on our pod or even in, at the bar in conversations.
Cool.
And this idea of conceptualizing the future that's different than market perception. I mean, that there's so many different rabbit holes that we can go down from there. But I mean, just from an idea generation perspective, I mean, how do you then lock in on something that, has some of the criteria that makes you want to dig deeper? Because you could just go from A to Z and make a case that, the conceptualization of their future might, probably 80% of microcaps, you could make that case that, there's how the company might ultimately end up. There's a different market perception, both on the good and the bad side, right? So how do you zone in on, okay, here's the swath of companies that we want to initially look at, and then dig in deeper?
Sure. It is worth mentioning that most of the companies we look at, we're not able to develop a concrete understanding of their future. Like, we just don't have the understanding, or are lacking in some sort of way where, or maybe it's just a little bit too volatile, it's just not very concrete how that company is going to compete, or how trends are going to affect that company, or so on. So most of the time it's like, oh, we don't know. But there are situations where we think we can know. And it really comes around to really trying to gain an understanding of attributes of a company, how it competes with other companies in the space, and then really getting an understanding of the external factor, really the ecosystem and the trends at play, and how that company fits in there. Understanding penetration rates, understanding cycles, and it gives you an idea. And the best way I like to describe it is that we've all, been to high school or college, and, had a friend that has certain attributes, and is going to a certain industry where it's pretty clear that they're going to be successful. Like, it's like, oh, they're disciplined, they're resilient, they're somewhat likable, they're industrious, they're going into an industry that has potential for growth. And you can gain some clarity, or some sort of concrete understanding of, hey, this person's gonna, they're gonna do okay. And it's very similar to what we do on the company side of things. So that is to give you a little idea. How we start with finding these companies is there's a structural way, and then a more tactical way. The structural way is just running all sorts of screens. So our screening is very, very broad, where companies with special dividends, companies that have increasing revenue growth, companies that have declining revenue growth, companies that have declining debt levels, companies that where a larger company has taken a stake in a smaller company, companies with different management changes, companies where maybe their DNA is much higher than their capex, where earnings is maybe understated cash flow. All these screens where potentially there could be a company where our view is likely to be variant when we do develop a view. Is somewhat the idea. Oh, there are also valuation screens, but then there are also tactical ways where, if there's some false narrative, and an industry sells off for whatever reason, then potentially the market is not accurately perceiving the future of that sector correctly, and we have a chance to see something different.
What are some of the, I guess, stop gaps or things that you have in place so you don't fall into the obvious traps? Let me say, like, for example, I've done, thousands of interviews now, in 13 years with some of these companies. And, you can I can make a case probably 98.4% of the time of, like, what I would think that CEO is thinking about for this business, or where they want it to be if all things go well 5 to 10 years, if it's lucky to still be around at that time. Whether even just in general, it's like, okay, this is an acquisition play. All right, drug gets to phase 3, or ultimately gets approved. On the retail side, just continued brand awareness, margin expansion, all that good stuff. So you can kind of make that case. So for you, how do you've been doing this long enough where I'm sure you could do very similar things where making that case for each one, but how do you not fall into the trap of like, all right, yeah, that it's easy to make this case, and yeah, it looks like that kid that we all thought might succeed or has all the attributes, but then ultimately become, whatever. We wish everybody well, but it didn't work out. Let's just say
Sure.
they didn't fulfill their potential.
Yeah, sure. So essentially, it's like how do you deal with the trap of just being completely wrong in your prediction?
Exactly. Yep.
So I think
It's a
that,
long-winded way of saying it.
yeah, for sure, for sure. I think that is the obvious question, and I think it's a very good question. And a lot of that comes from experience. A lot of it comes from making errors, in making enough errors where you understand that, oh, well, me trying to understand how consumer behavior is going to evolve or how preferences are going to shift is completely unpredictable. Why was I focusing my research efforts on that? You realize where your research has good ROI and where your insights actually have can give you that kind of understanding. A lot of the times, it's a game of not fooling yourself, because I don't know who said it. Like you're always the easiest person to fool, like as far as yourself goes. So there's a huge behavioral part of it as well. Like really understanding, like, do I know this company well enough to justify my perspective and why? And really going through all the disconfirming evidence and really being like clinically objective about your perspective and why it should hold up. So I think that a lot of it is just taking certain understandings about companies and putting that all together, synthesizing all that information, trying to separate signal from noise, and really coming to an understanding. And there's no real easy way to say it. I mean, you're in the predictions business. It's a game of, it's not a science. You're going to be wrong sometimes, and you have to have a sense of when your thesis might be at risk. And furthermore, after you make a prediction, after you form an understanding of a company, in real time, you have to be able to kind of reevaluate and determine if, hey, do I need to make any adjustments? Does this still hold, and so on, and don't fall into the trap of not updating your belief in the face of new information. Because that's certainly something that you have to do clinically well. It's existential that you do it well, not only essential.
Absolutely. All right. So the obvious next question from here, because, look, you have your research, you have public, right? So it's, all right, Bob, you guys are talking very esoterically on ideas and prediction, voluntary, like we got to get into a case study or an example here, right? Like that's just the obvious next part. So, I mean, do you want to go through an example on, how you utilize this strategy that you're like, all right, this worked out great. And then also maybe an example of like, all right, maybe this didn't work out as well, or this is where we found the fault in our prediction and we learned from that.
Yeah, I think that'd probably be the best way to do it, is get an example. And to just as a backdrop, when we are evaluating position or evaluating name, we have, no matter what it's currently doing, whether the revenue is declining or if the balance sheet doesn't look that great, or whatever the case may be, we have to be convicted in that company's ability to generate what we call value creating revenue growth. So it is a top, like, where we do have a value orientation, but it is a top line focused strategy. And we obviously, free cash flow is unbelievably important to us, because we do believe that ultimately the value of an asset is the future cash flows discounted present value. But we think of free cash flow as a byproduct of value creating revenue growth. To us, we would never invest in a company where we don't think that revenue growth element is going to be there. but they're cash flowing nicely, or through efficiency or whatever. We will never invest in a melting ice cube business, no matter how attractive the cash flows are today and if they're growing in a couple of years. To us, it's a top line focused strategy. So, but the caveat is it's a specific type of top line. Like, we're generally skeptical of revenue growth in general. So to us, it has to be value creating revenue growth. As far as to give you an example of maybe where we got this right and where we got it wrong, that I think is instructive, is a company called Donnelley Financial. I don't know if you heard of it. They spun off from R. Donnelley in 2016. The stock just went straight down. Like, I think probably day after day. And those are actually graphs that we like to see, because you have a very fatigued investor base, and if there is something going on there under the hood that is going to be different in the future, you're going to get a huge churn investor base, and you're going to get upside for a very long time. But anyway, so the company was viewed as a printer, which is, they used to print, companies that are, it's in the reg tech industry, companies are filing 10Ks, 10Qs, any sort of debt documents, AKs, IPOs, they would help them kind of print and disseminate this information to investors. And they're transitioning into tech-driven solutions. But while they were doing that, their share was just getting absolutely eaten. They were getting eaten alive by a company called Workiva that had this amazing tech solution. And Workiva was able to charge an enormous amount for this product. But you could start to see that Donnelley still retained brand power, still retained great awareness. And they had brought in Microsoft, and they started to develop their own tech solutions as well. And we actually went through and scraped all the SEC data. At the bottom of all these filings, they tell you, who helped them produce their reports. And you started to see Active Disclosure, which was Donnelley Financial's product. You started to see it gain share in the underlying filings. So you could see it actually starting to turn around, but nobody's giving the company credit for it. Furthermore, to compound things, Donnelley tends to be heavily tethered towards the capital market cycle, IPOs especially. And around 2020, when we got in the name, early 2020, everybody thought IPOs were dead. They're like, companies are either going to come to market via direct listing, or they're going to stay private. And that was the prevailing belief, because the cycle was at such a trough. And if you realize that, well, at the end of the day, that public markets are really the only game in town for people who want the top dollar for their equity, and CEOs want to be on leaderboards. There are all sorts of reasons why IPOs are going to continue in the same within the same ecosystem they have been in the past. So we correctly surmised it was the bottom of the cycle. They were taking back their share. The future was certainly going to look brighter for Donnelley, we thought, in the past, and it ended up being an unbelievably, fortuitous, because the cycle turned so rapidly, obviously. But the investment ended up working out. We still own it. It's up. We got in at about $7, and it's over $60 a share right now. So that's an example where it's like, oh, you had a certain conceptualization in the future that turned out to be correct. So let's talk more interesting conceptualization about the future turned out to be incorrect. Around the same time, we got in a company called American Outdoor Brands, which was a spinoff from Smith & Wesson. And they really sell, just outdoor, outdoor products to people who like the outdoors, like, stuff to do with tents or knives or, different camping equipment. They sell all that stuff. And what you had post-COVID was this huge surge in people wanting to pursue outdoor activities. And we spent a lot of time thinking about, like, oh, are people going to continue to do this, or are they not? And we came to the realization, that it'll likely continue, or maybe it'll grow at some marginal rate. And really, the answer should have been that we have no idea. Like, we don't know how people's preferences will evolve in this area. Maybe it can go up, maybe down, maybe go sideways. We just don't know. But we fooled ourselves into thinking that, this is a situation where this is likely to be a trend that stays, or for X, Y, and Z reasons. And we ended up being quite wrong about that prediction. And we did not exit the position as quickly as we should have, when we realized things were moving against us a little bit. So that was a situation where we were like, okay, okay, now we're just going to really just focus on things we know for sure have predictive value, and just double down on those and disregard all the other, especially like Warren Buffett talks about a circle of competence. Like there's a circle of ignorance that's equally as important that you need to draw a line around and say that, hey, I know I'm not going to be able to say anything meaningful in those areas, and I'm not even going to try. And learning to kind of just to give up, really, like is is a really important skill for investors.
Absolutely. Those are two great examples, man. Thank you for sharing those. And so my follow-up to is specifically actually that American Outdoor Brands one, and not specifically to that, but just based on that experience. It signals something in my head that, you kind of more or less answered, but maybe we can explore it a little further. And the question that popped up, well, firstly, you said you want to focus on things that have predictive value. So two-part question. One, for you, what are the things that you guys like to focus on that you feel have that predictive value? And two, what have been those trends or themes that have been most difficult to conceptualize and develop some sort of predictive value?
Yeah, great question. So usually we like to split our portfolio up into ones that are trend driven versus ones that are more cyclical. So, when we talk about trends, we actually mean something different than maybe most people. When we talk about trends, we're purely thinking of penetration rates, and we're thinking of either a technology or some sort of process or whatever the deal is, where you can gain enormous amounts of clarity. That penetration rate is going to be higher in the future than it is today. And if you can gain clarity over that, potentially, if you find a company that fits well in that area, you can be very confident in their durability of growth. So, like to give you an example of a penetration rate, right now we own a company called Remitly, where there is a large move to electronification of cash, as a result of the rise of mobile phones and so on, and because of like digital remittances, which is migrants sending money across borders to their friends and family, digital remittances will continue to eat share from just the overall remittance industry when you look at digital versus cash. So it's like, okay, if I can find a good digital player in this arena, I can have total confidence that digital is going to continue to increase penetration for obvious reasons. So so there's certain tailwinds, or they fit a certain trend. Number one, and number two, this company has the right advantages for these reasons, and it's continuing to buttress those advantages, and those advantages are getting stronger. So once you pair those two together, you can have a large amount of conviction in what the future of that firm is going to look like. You have to understand the unit economics. You have to understand that its growth is value creating. So there's definitely aspects of the business that you would need to understand very, very well. But once you put those two together, that's a way that you can gain predictive value in our opinion. And obviously this is just based on our experience and our theories about market and so on. The other part of it is cyclical, which sometimes is less clear, but through historical studies and through understanding certain aspects of cycles, you can gain some sort of clarity that you're near the trough of a cycle, which means that the future for certain firms in that trough cycle are likely to be brighter than the current state. So those are two ways you can gain some sort of predictive value. Again, it's not just the external side of things. You really have to understand the company well and how it fits within that broader ecosystem. That's unbelievably important. On the other side of things, what we can't predict, and my brother and I actually disagree on this a little bit, where I think that there's certain things that in markets that no matter how smart you are, no matter how many AI models you have, if you had all the information, if you understood the spin state of every single particle in the entire universe, you could still not say with a high degree of confidence what is going to happen in the future with like consumer preferences or different aspects of consumer behavior. Like I believe like it's inherently unpredictable no matter what tools you have at your disposal. Where my brother thinks that if you had this giant AI supercomputer that could crunch every single number in the universe, potentially you could come to that realization, where I disagree. But that's but that's an area. Anything to do with preferences, anything to do with you know, what consumers might be doing at the moment, you know, we have no idea. Like, we just don't know.
Not only that, it's also very difficult. I mean, I totally agree. I figured that's where you're going with it, especially after the American brand outdoor brands
For
experience.
sure.
Like that makes total sense. Because I mean, you can't predict that. One day this kind of gene is in vogue, and now predicting this kind
Yeah.
of whatever just using clothing for example. Like that's just impossible. I guess you could. Maybe. I mean, I can see what your brother's saying because there are certain things that humans will always love to do, right? But it's also difficult in being, I guess, really the question is being able to predict, all right, there will always be a market for, let's say, camping, right? But the hard part is predicting, the peaks and valleys of its, I guess, prevalence or popularity at that given time. Like that's probably, I would take it that maybe a step further. Is like I would say there is maybe some things like overall things, but like to your point, it's just very difficult to see like, all right, well, when will this then peak again, or when's the cycle of this going to be really popular again or whatnot.
Absolutely. Yeah, I agree that you can understand why certain things exist, but we're in the predictions business. When you're in the predictions business, you care about how things are going to change,
Yeah.
and how things are going to move. But yeah, like, are more people going to like camping to a greater degree in the future? Are people going to buy more red cars and blue cars in the future? Like, I have no idea, and I'm not going to know. And there's even like right now, like, we looked at a casual diner, and it's very hard for us to know if casual dining is going to be around in the next 10 years in the way that it is today. I just don't know. So, cost structures have changed. People, preferences have changed a little bit. Like, I just don't, I don't know what's going to happen in
Like
that area. So
that's an interesting
yeah,
one because on one hand you're thinking to yourself like, because I mean, we're California. We're health focused. I would assume you're in the
yeah,
same boat as me. I don't need a McDonald's or anything like that. But the
yeah,
concept of fast casual and like, casual dining, I don't think that's going away. But what, how is that going to change, right? And as a result, will more or
yes,
less
yes.
people be going to those or more people going to be entrepreneurial and wanting to start up a casual dining place. I don't know, we could go down this rabbit hole forever. I mean,
For sure. And the companies we were looking at were Chili, Red Robin, in that area.
yeah,
Fast casual, I agree. You can make obviously the case for Chipotle and what's the new one? Canva, or ticker CVNA.
yeah,
But
it's
yeah,
getting a
so
lot of FinTwit buzz for sure.
yeah, for sure. So yeah, but like, what would be your opinion on like Red Robin or Chili's or something like that? Do
Or
you
like
think it's going
Ruby
to be
Tuesdays. I mean,
Ruby? Yeah, stuff like that.
for full disclosure, not a shareholder, and this is not investing advice
Likewise,
whatsoever.
yeah,
But I mean, I just know my preferences changed as I got older, right? Like when I
yeah,
was a young
yeah.
moron, like Chili's is open, let's go to Chili's. Great. Like, do I care that I'm having a burger? I'm 18 years old. I'm just hungry and want to destroy, a burger with fries. Like, let's go. But I'm 36 now, or almost 36, and with young kids, and know the health benefits of not eating out like that twice a week versus once a year. And
Yeah,
also realizing that In-N-Out's the best burger of all time. So why would I waste my time at any of these places when I could just go to In-N-Out and
for sure.
have a double single animal style, no pickle, and
Yeah. Well,
perfectly
let me
happy.
ask you another one that's difficult to predict for me. Like, I just think it's very, very difficult to know, and that's like alcohol consumption or wine consumption.
Yeah,
Um,
that's
how
another
is that
one.
going to evolve? Is that going to be at a lower level in the future, or is it just a cyclical thing, and then young people start drinking wine in the same amounts when they get older? Like that, to us, it's easy to say, oh, let's look at some wine stocks. They've sold off a bunch, but how do you really know what the future is going to look like
I'd
there?
even throw in cannabis consumption as well.
Yeah, sure. I totally agree.
Like I
Yeah,
think there's definitely a question there, and maybe in the ways in which it's consumed also, right? consumables might be more in vogue versus flour.
Yep.
Like that all these questions are very good questions from a consumer standpoint that is impossible to predict. Um,
I totally agree with you. I
and
know
like
there are
we can
people that
speak
would disagree with me,
personally.
but
Yeah.
yeah,
Like we can
yeah,
speak
for sure.
personally on that. And again, it goes back to like it'll probably always be there,
Yeah,
but again, it's either how it's consumed, how much it's consumed, how popular. Is it all going to be based on brand or like that? It's just very difficult to predict. And
I agree.
yeah. So, man, this is so fun. I could jam on this all day, but we do have to stay on topic. I mean, one question I ask everybody on here that I'd love to hear your experience here. What would you say was an investing experience or an experience while ironing out your thesis and ironing out your philosophy that would you say you learned the most from, or maybe guided you and say, okay, that helped me arrive to this is where I want to be in terms of how we think about investing, how we think about looking at companies.
I think there was a lot of epiphanies along the way. I think that a lot of it has to do with reading the current literature and how different investors are thinking now, and then putting that into practice, and then seeing your results, and then continuing just that constant refinement. Um, but just as an example out throughout my career that got me to see things in a different way that was like very clear. And when you said that, this is the example that came to mind, or the instance that came to mind, was when I was working at, I believe I was working at Morgan Stanley at the time. I just entered the industry, and or no, this was a couple years after I had entered the industry, and we were on a New York trip, like meeting different money managers or hedge funds specifically. Because our business was about putting client capital in multi-asset classes, stocks, bonds, and alternatives, which is involves hedge funds and all sorts of things. So this was also around the time of the Valiant debacle or disaster, where Ackman had taken a big position in Valiant, and had all sorts of reasons why it was going to succeed, or so on and so forth. And then we met, I don't know, 10 or 15 different hedge funds that day, and most of them owned Valiant. And to me, it was like, whoa, I thought these guys were unbelievably sophisticated, unbelievably intelligent, and here they are just piggybacking on each other for this one trade. Like, how sophisticated can they really be? And I got to peel back the curtains a little bit and see how these different hedge funds operate, and a lot of them do have sophisticated and enviable operations, but a lot of them are kind of just flying by the seat of their pants. And it's funny because people have this concept of like money managers and how unbelievably professional and intelligent these guys are, when really, like, success as a money manager optimizes for marketing ability, for networking, for your institutional relationships. It's not necessarily skill. And often, as long as, like, I'd much rather the success of a money manager, I would much rather take somebody who is kind of had okay skill and amazing marketing ability versus like amazing skill and not so good marketing ability. I think marketing ability goes a really long way in our industry, and the larger proportion of money managers tend to be quite good in those areas. Well, marketing and so on. So to me, that was a big part of the learning process, was the realizing that, hey, these guys really aren't that good, and they don't know everything, and hey, you can find different ways to compete against the so-called best professionals in our arena.
Absolutely. All right, man. I mean, we've covered so much, and at risk of this podcast going 3 hours, I figured I'd try and at
Sure.
least have a TBD or TBC to be continued for the next time you come back, because I'm sure we'll be jamming on a whole host of topics next time, and doing some future proofing and all that stuff. So, to close us out, what advice would you have for folks that maybe want to try and adopt this idea of conceptualizing the future, how they should think about it and how they should do it?
I think that they should just take a more prediction approach to their entire lives, like really trying to, always keep track of your expectations and how they're different than reality, and understand, be very attracted to areas where you're wrong, and be very attracted to disconfirming evidence, as opposed to walking around your head and thinking you're right all the time. So if you can just realize that you're going to be wrong a lot of times, and you're just going to try to improve your prediction error, I think that just that mindset is it's not easy to find in people. People don't naturally think that way. People don't like to think of themselves and their ideas as oftentimes being wrong a lot. It's just not the way we're wired. So yeah, I think that if they can do that, it's going to go a long way in trying to help them along that, trying to conceptualize the future, at least maybe similar to the ways that we do.
Very cool. All right, so let's leave it there. Deiya, where can our audience go and find more information to follow you on social media as well as subscribe to, right? Because I'm pretty sure you have a newsletter that sends out all the updates and whatnot. So where they can go subscribe as well as follow you on socials.
Yeah, absolutely. PernasResearch.com. You can go in and add your email to receive our research, and also PernasResearch.com or Pernas Research on Twitter. And then we post a lot of our thoughts on there as well. So
heck yeah. Good stuff. All right. Yeah. Well, Dad, thank you so much for joining me today. Really do appreciate it. Have a great weekend, and look forward to our next conversation.
For sure. Thanks a lot, Bobby. I really enjoyed it.
Thank you.
See you.